So what we're seeing at the moment, which might be terribly exciting for the bulls, gold rushing up to 3,900 and, looking as people forecasting it's going to go 4,300 or whatever. That's just the start of it. This is actually, I think, a crisis developing within the precious metals market. And what we see in gold, we're also seeing in silver. The story in silver is obviously different, but China again has been a big player in silver as one of the leading global mining nations. Not only that, but over a long period of time they've been importing silver doré, refining it, hanging on to silver, but using their clout to keep the price suppressed. That's no longer happening. Precious metals markets. The thing that's fascinating is the squeeze on the system. They're not overbought, and a lot of the time you see, prices rising while open interest on COMEX is contracting. It's an extraordinary situation, and we're hitting new high ground in gold and silver in particular. All this indicates is a lack of liquidity. And fascinatingly, the stand for deliveries on COMEX, yesterday, the last day of September, it was absolutely huge, something like 66 tons, 65 tons of gold, and sort of over 1,000 tons of silver. These are enormous amounts for a market which was never intended to act as a delivery mechanism. And I think it sort of indicates that, people wanting gold or silver in size, they can't go to the refineries because they're all sold out. They'll deliver in sort of join the queue sort of thing. So the only alternative really is to go to the futures markets, pay a premium, if you like, to pick the stuff up and then stand for delivery. And that's what's happening. I think, in both cases, I think China has got quite a lot to do with this. In the case of gold, China has more or less cornered the gold market. I put out a note today analyzing how much gold China actually has, China and her citizens. And, if you want to read it, you can pick it up on my Substack. But I reckon, and I'm fairly confident of these figures, that China has something like 75,500 tons between it and its citizens. Bear in mind that it's been accumulating this since 1983. So we're talking about over a long period of time. Also in a big bear market between 1983 and 2002. And it was at a time when we were selling gold hugely. We were selling not only our gold as investors, but also the central banks were selling gold.
Behind this squeeze stands a quiet but powerful force, China. Since the 1980s, China has steadily built one of the largest gold stockpiles in history. By some credible estimates, combined state and citizen holdings exceed 75,000 tons, over a third of all above-ground gold globally. Much of this accumulation occurred during Western sell-offs in the late 20th century, when central banks and investors unloaded gold in favor of U.S. treasuries, while others sold, China bought. Today, this vast reserve gives Beijing strategic leverage in global finance, while leaving Western markets underprepared for any supply shock.
And not only were they selling gold, but people were taking delivery of gold, leased gold, and selling it into the market and putting the funds into US treasuries. And the gold disappeared. Guess who was buying it? China. The point is that if you look at the above ground stocks of around about 200,000 tons, look at how much gold China has got. We're looking at 36% of all above ground stock. It's leaving everybody else short. It's a short answer. And so we're seeing the squeeze now. And, the major US banks, amongst others, are beginning to get bullish on gold, and they manage portfolios which have no gold. And at the moment, while the Magnificent Seven are soaring and credit bubble is intact, perhaps underlying investors don't care too much. But when that pops and they've got no gold, they'll be looking at a very, very different situation. And I think that these banks are beginning to realize that they've got to have some gold. But if you look at just adding to the 0.5% which global portfolios own of physical gold, if you take that up by 1%, they've got to find 25,000 tons at current prices. It's not there. It is not there. And this buying is going to happen. Of that, there is absolutely no doubt whatsoever.
Major Western banks and portfolio managers, long indifferent to gold, are beginning to rethink their stance. Global portfolios hold only around 0.5% of assets in physical gold. A mere 1% increase in allocation would require over 25,000 tons, metal that simply doesn't exist in accessible form. As the credit bubble shows signs of strain and the Magnificent Seven tech stocks dominate headlines, smart money is hedging. This awakening among institutions is fueling additional demand, pushing prices toward levels not seen before, and challenging decades-old assumptions about gold's role in modern finance.
So what we're seeing at the moment, which might be terribly exciting for the bulls, gold rushing up to 3,900 and, looking as people forecasting it's going to go 4,300 or whatever. That's just the start of it. This is actually, I think, a crisis developing within the precious metals market. And what we see in gold, we're also seeing in silver. The story in silver is obviously different, but China again has been a big player in silver as one of the leading global mining nations. Not only that, but over a long period of time, they've been importing silver doré, refining it, hanging on to silver, but using their clout to keep the price suppressed. That's no longer happening. So we've got shortages developing in silver now, too, as far as Western capital markets are concerned. The fact is that, pricing of these things is no longer under our control. It's all gone on to Shanghai. And what we're seeing the squeeze on the establishment, the people who are short, not just establishment. If you look at the commitment of traders figures, you'll find that even managed funds have short positions. They're net long, but they've still got some short positions.
Silver, often overshadowed by gold, is now following a similar trajectory. China, a major producer and refiner, has quietly retained large silver reserves while keeping global prices subdued for years. That strategy is ending. Western refiners face supply shortfalls, and the Shanghai markets are increasingly setting the tone for pricing, not New York. Commitment of traders data shows even managed funds remain partially short, while swap dealers carry heavy net short positions. As physical demand intensifies, these shorts are becoming liabilities, amplifying pressure on the system and signaling the start of a broader silver supply crunch.
The swaps, obviously, a big net short. The liabilities that are mounting up on the shorts are just staggering, absolutely staggering. So, it's a squeeze on the system. And I think actually, Danny, what we're looking at, if you stand back, we're looking at the dying days of the fiat currency system. And, that basically means that after a period of time, it doesn't matter don't know how long it'll be, but I suspect it won't be all that long. Unless governments actually manage to pin their currencies to gold, they'll become valueless. They'll go down to close to zero. I really can't see the politicians even thinking that they need to protect their currencies. They're still spendthrifts. They're still, having huge, great deficits on their budgets. They don't care. They just complain that the markets need higher interest rates. Well, it's hardly surprising. You're going to need higher interest rates still. And meanwhile, everybody in the market, in this credit bubble, assumes that inflation is going to diminish. But I mean, the thing they get wrong is it's not, sort of prices, if you like, in that sense. It's the loss of purchasing power of the currency. That's what they've got to look out for. And if I'm right that we are in the dying days of the fiat currency system, then prices are going to soar in the next 2 years. And that is something which, of course, nobody expects. But it won't be prices going up. It'll be the value of currencies going down, their purchasing power collapsing. And of course, as soon as people realize that, they dump the currency for anything they can get with it. I think that's the future. I'm very sorry to say.
The growing squeeze in gold and silver markets points to a deeper issue, the fragility of fiat currencies. Governments continue to run massive deficits, assuming inflation will fade. But inflation is not just rising prices, it's the erosion of purchasing power. If trust in currencies weakens further, investors may rush into tangible assets. Historically, monetary systems built on credit but not anchored to real value eventually face reckoning. Analysts warn that without credible backing, such as a partial return to gold, major currencies could lose significant value in the coming years, triggering rapid capital flight.
I think we have to, if you like, divide out bullion banks from others in the market, as it were. I mean, bullion banks will try and run a balanced position as much as possible. Where they're short on COMEX, they're probably long in London, sort of thing. But when you've got hedge funds, when you've got people, and maybe market makers just making a market in the swaps rather than having positions in London as well, then they could become, if you like, a systemic problem, which I think they try and cover up. They must try and cover it up. I think it's not impossible that a bullion bank will get into difficulties, but I think it's more likely it's amongst their clients that the difficulties will arise. That would be my view anyway.
And if that occurs, what are some of the first and second order effects of that?
Well, within the COMEX rules, they can declare force majeure, but nobody's going to want to see that at all. I think what's likely to happen is there will be a rescue behind the scenes. We won't know about it. It'll be hushed up. It'll be very, very quiet, but it will happen. And it wouldn't surprise me if that happens quite soon. But, we're not to know about it because if you get a failure in these markets, particularly gold and silver, this could undermine the whole of the derivative industry. I mean, because we're not just talking about, those derivatives. I mean, they are central to everything. Just think about the extra pyramid, with gold at the bottom supporting everything else. I mean, that might exaggerate the position a little bit, but you can see how important gold is in all this. And if you get a failure in what is actually legally money and all else is credit, in the failure in real money counterparties, then this is serious. You've got to bear in mind that the market has moved. It's now over in Shanghai. I mean, the physical market's over there, not over here.
The stakes are higher than most realize. Gold sits at the base of the global derivatives pyramid. A failure in physical settlement could ripple through commodities, foreign exchange, and broader financial markets. While COMEX has legal mechanisms like force majeure, authorities would likely intervene behind the scenes to prevent visible collapse. Yet the shift of physical trade toward Shanghai weakens Western control. As gold leads other commodities higher, base metals and energy may follow, straining fiat currencies further. This isn't just a bull market, it may be the early stage of a systemic monetary reset.
In terms of, if you like, contagion from gold and silver derivatives, you've got the same counterparties operating in all these markets. So you are going to get that contagion, if you like, spreading across. And it's not just those markets, because once you spread from gold and silver into other commodities, you also, going into counterparty failures in the other really large derivative markets, and even in foreign exchange and things like that. So, it's got to be stopped, basically, and they will stop it. But as to your point about commodity prices rising and all the rest of it, I would note that gold is leading the way upwards in commodities. And my view is that it's likely to drag other commodities like base metals, for example, and energy up with it, but particularly base metals. I mean, they are, relative to gold, they are now cheaper than they have ever been. And since gold is the real money standard, as it were, even though that's being driven up, if you like, by markets, I would see that all these relationships are going to come under huge, huge strain. And it's not good for the purchasing power of paper currencies.